Interest rates explained without the spin for the San Antonio and Texas Hill Country area. Let's talk about interest rates. No headlines, no hype, no fear-based advice. Just the truth. If you're hearing things like rates are coming down, just wait, or buy now or you'll miss out, I want to slow this conversation down and explain what interest rates actually mean for buyers in the San Antonio and Hill Country area. This is for you if you're thinking, 1, should I buy now or wait? 2, how much will my payments really be? Or 3, do interest rates ruin my buying power? I'm Audrey, a local realtor, and this is Real Estate Without the Spin. Interest rates affect 3 things: your monthly payment, how much house you can qualify for, how much interest rate you pay over time. They do not control your life, your job, or your timeline. That's all up to you. Rates are important, but they're only one piece of the puzzle. If you want a personalized payment breakdown with real numbers and no pressure, feel free to reach out to me. I'll walk it through with you. So let's take a real example. We've got a pre-owned home in San Antonio, and then we've got another home, a brand new home built by a builder. So we've got these 2 homes. One's at 6.2 interest rate, the other's at 4.9. So we've got a same price home at $400,000, and we've got one at a higher interest rate, one at a lower interest rate. Let's take a look at what difference that makes. So 2 different interest rates. One buyer purchases at 6.2% interest rate, which is the going rate right now. Another one's going to purchase at 4.9. That's a possible rate for a new home purchase. Now, pay attention here. Taxes and insurance don't change in this example. So we're going to take the same price house, the same price taxes, and the same price on insurance to come up with our payment. So property taxes are running an estimated $4,500 a year. That's roughly $375 a month. And then we've got homeowners insurance running about $135 a month. These costs are fixed, and the only thing changing is the interest rate. So scenario number 1, the house is purchased at a 6.2 interest rate. So the house is $400,000, 6.2 interest rate. So for principal and interest alone, before taxes and insurance, it's $24.50 per month. Then we add in the escrow amount for the taxes at $375 a month and the homeowner's insurance at $135 a month, with a grand total due of $2,950 a month. Now, if we take scenario number 2 and you buy the same house or a house valued at the same with about the same tax rate, we have the 4.9 interest rate home, and we're looking at a principal and interest of about $2,120 and taxes of $375 with insurance at $135, with a total payment of $2,630 a month. So the real difference is roughly $330 per month for that same price house. The only difference was the interest rate. Yes, rates matter, but here's what most people miss. If this is helping you make sense of interest rates, please hit like. It will help other people be able to see this video and help them understand it as well. Now, how much more house can I buy at $330 a month? $330 a month, if you decide you want to buy a bigger house, or you're looking at pre-owned at 6.2, and then your agent says, hey, let's go look at a new home build because we can't seem to find what you want. You want a 4-bedroom and we can only find a 3-bedroom in this area. Well, if we go look at this new builder and they've got a special promotion where you can get a 4.9 interest rate, but you can get that 4th bedroom or that study or that larger lot. So if you go out there, you can say, well, you can qualify for more home. You can buy a $450,000 home. That difference in the interest rate from 6.2 to 4.9 equals about $330 a month, which also equates in value of a home anywhere between $50,000 to $60,000. So you could buy a $450,000 house for the same amount you could buy a pre-owned home at 6.2 interest rate. That's something to consider as well. At the lower interest rate, you can buy more house, or you can feel less stress monthly because your payment's not as high, and you can qualify more comfortably. It's a lot easier to qualify. At the higher interest rate, if you want to be in a certain area or closer in, you can choose a smaller house or buy further out or plan strategically. Like maybe you decide to pick a house that needs new flooring or needs new paint. I love a house that needs paint because that's such an easy fix. And people sometimes just can't see it, that, you can get a better deal if something just doesn't look as beautiful, but you can make it how you want without a whole lot of work. So these are some of the things you need to think about. And then sometimes people get in and they think about, oh, I'll just refinance. But I don't ever tell people, oh, let's plan on refinancing right away, because that's not how it works. I never tell a buyer, just refinance later. Refinancing depends on several things. So when you refinance, you need to know this. If you're going to wait a year or 2 or 3 or 4 to refinance, you need to know that your credit's going to be looked at that time. So don't go run up the bills, getting all new furniture and everything. Also, your income at the time and the value of the home based on market value and market conditions. Those things can all be affected, so you can't guarantee anything. Things may get a lot better or get worse. So the goal is to buy comfortably today with flexibility for tomorrow. And I will say that I did buy a home and I refinanced. I bought at 6.5%, and about 6 years later, I refinanced at 4%. So I dropped 2.5%. Mind you, people say, oh, wow, that's such a savings. Well, I decided I wanted to cut off 9 years in payments from that original 30-year loan, so I changed it to a 15-year mortgage. My payments did go up a little bit, but guess what? I got that house paid off in 21 years, so I feel really good about that. That's a lot of money saved. That's something to keep in mind. Do you know that you can buy a house with no money down? That people are really surprised. I mean, you need to have a little bit for your inspection and down payment, but you might end up getting the down payment back. So for example, we have a lot in the San Antonio area. There's one called a USDA loan. That means it's considered in a rural area. But what's interesting is a lot of areas in San Antonio are considered rural, even some places in Helotes. USDA loans allow you to not have to make a down payment. And a lot of times the people selling the homes are helping to cover your closing costs right now. So it is very, very possible. Another zero down is the VA loans. You don't have to put any down payment down, and often the sellers do cover your closing costs. The other one is there's a lot of city, state, and county programs for people. They do change, so we'll have to consult with the lenders, but they have a lot of programs that help with no money down programs that help you get into a house. So we just have to check qualifications, see if you qualify, but you definitely can. These programs are very important, and we would have to provide some guidance for you on there, but they do exist. So in final truth, no spin. Interest rates do matter, but they're not everything. Waiting only works if prices and rates both drop. Buying only works if the payment fits your life. There's no perfect rate. There's only a smart strategy. So if you're thinking about buying in San Antonio or the Texas Hill Country, and you want straight answers, real numbers, and no pressure, please hit subscribe and contact me directly. My information's below. I'm Audrey Etheridge, and this is Real Estate Without the Spin.